There are so many things impacting financial markets, but in the US market, the Fed is lowering its probability of a 25 basis point increase, and that's causing the stock market to rally. We can see that this percentage is falling. 1 month ago it was 43.6%, 1 week ago 28.2%, 1 day ago 12%, and right now it's 10.4%. We've seen yields coming down, and just bear in mind that when you get downward progression on the US 2-year, a potential rally is incoming. And we can see that's actually the case. The S&P 500 is coming up. It's pulling Bitcoin and total crypto market cap up with it. Not just that, but all markets are being pulled up right now. We've seen the DXY lose its internal structure. One particularly important level was this structural support level right here, and this particular exclamation mark is the Hamas invasion of Israel. That 106.2442 mark is really important, and we've seen the price couldn't hold itself above it. It's decayed below and also retested. The DXY could well be on the way to 105.6365 if you're shorting. And if you think it's a bullish price momentum, keep your eye on 106.0822. Falling yields pull the DXY down, and the DXY controls so many other currencies. We're seeing the euro dollar, the fibre start to get positive momentum, the Aussie dollar and the Kiwi dollar, and the cable, the Great British Pound versus the dollar, all starting to strengthen. China is also seeking to push stimulus higher in order to protect its all-important real estate sector. There's always good news and bad news inside financial markets, and the threat to Israel from Hezbollah and Iran raises the risk of wider conflict. Previously, when Russia invaded the Ukraine, we had a big surge up in the VIX, and then it spiked down. We're seeing a very similar thing right now. Fear is starting to leave the market, but will it continue? Oil prices are highly inflationary, so we need to know the structural levels. Oil prices and defense stocks rise as Israel-Hamas conflict rattles the markets. Another thing to bear in mind, Israel orders shutdown of key gas field as the war rages. We saw oil spiking up, but it hit the structural level at 85.91. That CTKS structure has overridden the upward price momentum in oil. Oil is starting to look more positive, and if we get the bullish side of oil coming out, we would expect a movement to 87.58. But if we lose this structural support level down a little bit at 85.84, we would expect to fall to 85.19, or even a lower fall to 84.09. To gold investors, gold has been wildly disappointing, and that's because two structural levels got in the road of gold's ascent. This one at 1851 and the higher one at 1857. These two structural lines are drawn from 1833. This is not recent indicative price, but we can see gold starting to consolidate around this particular structural level. That's really good news. If gold maintains a bullish course, it's headed up to the next structural level at 1872. If it fails, it's heading to the one below at 1851. With the concept of yields coming down, that's fantastic for the bond market. It's also really good news for gold, but gold structural levels are giving gold a headache at the moment. With the DXY coming down, that's incredibly good for crypto as well. Oil continues to be a problem, and we've seen some relief in terms of junk bonds, and we understand that when war breaks out we get an initial pump up in terms of the VIX, the fear reading of the market, followed by a movement down. It doesn't mean that confidence has been restored into the market, but the concept of the Fed not increasing interest rates is really good news. The US leads global markets, and as the S&P 500, the Dow, the Russell and the Nasdaq show positive price momentum, we can see that it's translating into global positive price momentum. All markets and therefore charts are intercorrelated and interdependent. You must learn how to read dependencies between charts if you want to be consistently profitable. The risk-on behavior is flowing through to the crypto market, but it's muted. We can see there's been some recovery across the top alts, but not really that much. So far, the markets are remaining red. To be consistently profitable, always let price reality be your guide. There is a structural resistance level at 27,827. If we get above that, we're going up to the next structural level at 28,430. However, if we can't get above resistance, we're going down, and that would be to 27,356. The certainty you get inside financial markets is to follow price reality, know the structural levels, and be absolutely certain as to your reactions if price moves against you, moves for you, or goes nowhere. When we look at total crypto market cap, the alts have been bleeding recently. One thing to note, the structure underneath price is very weak at the moment. There's one structural support level, and this is drawn all the way since 2014 at 1.051 trillion. But if we lose that, we're heading down to 1.029 trillion. That could be pretty harsh for the alts. If we maintain positive direction and positive bias inside the crypto market, we're heading up to 1.06 trillion. Knowing your structural levels underneath the charts is an absolute game changer, and if we look at Ethereum, we can see something very specific. Ethereum has a massive amount of structural resistance at the 1595 mark. Ethereum has tried to get back above this, but has very little success. It's found support levels below the current price and rebounded from them, but it still needs to overcome this 1595 level. If it can get above, it's going to the next one at 1605. If it can get above that one, it's going to the next one at 1624. Fortunately, we're sitting smack bang on a structural support level at 1589, but if the bears take over, we're heading down to 1568 or the lower structural support level at 1565. The certainty comes from financial markets is the certainty you will do what you say you will do if price moves against you, goes for you, or goes nowhere. The other levels of certainty come from rules that you create, or rules that you learn from other people who are professionals. One very powerful rule is that price is always moving between structural levels. It's very important to know where these structural levels are and have the skill to draw them out as well. The crypto market in the past 24 hours has witnessed nearly $107 million worth of total liquidations, and you can see the majority of those liquidations have been long relative to the shorts. That's why we see so much green across this market. Green means the price is coming down, and you can see over time things shift around quite substantially. That's because of a specific rule: price moves in waves. Right now, we're not seeing big reductions or big increases in the crypto market. The greatest gainers in the past 24 hours: Tezos, Atom, Clayton, OKB, XDC, TWT, and BSV. The greatest losers top 100 past 24 hours: Conflux, EGLD, Wu, IOTA, Mana, Filecoin, and TON. The Crypto Fear and Greed Index currently is just neutral, and we've seen that it's been flatlining for quite some time. Financial markets are incredibly complex, and you need to be able to stack probabilities. To do that, you need to understand the structural buy and sell levels on the Tier 1 charts, Tier 2 and Tier 3, but especially the Tier 1 charts. By knowing this, you'll see how all the different charts interact and interrelate to each other. They give you incredible timing signals. For the monthly service, all the Tier 1s have been released, just about all the Tier 2s with the exception of silver. Stacking probabilities, understanding cross dependencies, knowing where the structural support and resistance levels are is very important. And also, it takes about a decade inside financial markets to understand the doom cycle. The doom cycle is all about emotional mastery. When losses are made inside financial markets, it is not personal. It's the market teaching you that there's a rule that you need to obey. If you obey the rule, you will make profit and you will avoid losses. When I said this particular cycle takes about 10 years to learn, the reason for that is that the first thing, the most natural thing, is for us to get really angry, really hurt. After all, we've lost money, and seek to blame an external target for our loss. Unfortunately, the market doesn't care about such things. It only cares that you learn the market rule. If you learn the market rule, you will make profit. If you don't learn the rule, you will suffer compounding losses. To escape the doom cycle, after about 10 years, people get into the awareness and understanding phase. They go through the insight cycle, where they just say, market, you're teaching me another lesson. I know it's not personal. I've lost money because I disobeyed a rule inside the market. Now let me figure out what that actually is. A critically important rule is Rule 774, Master yourself to master the market. This means that we must not come from a position of fear when we're putting our money on the line. That is really difficult to do unless you have knowledge. Losses could result because you're seeking to go too fast before you have the foundations. Maybe you're not checking the stock markets and world events, collecting probabilities, which violates many rules. Maybe you're not sure how to find the market's focus, understanding that opportunities reset daily and enhancing your pattern recognition. Perhaps you have not yet mastered fear or emotional control. What this actually means is we're allowing fear to make the buying and selling decisions for us, instead of knowledge, experience, and expertise. There are so many ways to make money, but of course, patience is important. If you would like to learn these foundations and much more, Purpuratum has very kindly offered a CTKS Partial Masterclass Scholarship. If you're interested, you can fill out the form in the description of this video. And you can also check out the masterclass, it's very highly awarded. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again in the next video. Bye for now.